Well, the stock market continues to ping pong back and forth, but today I did take the opportunity to purchase Tyson Foods. That's ticker symbol TSN. Incidentally, you'll always know when I buy or sell something in my model portfolio because I blog about it over at the market commentary section of investablewealth.com. You can read that at your leisure. You can also subscribe for free to receive email notifications. Now, as far as my rationale for purchasing Tyson Foods, it's been on my watch list for quite some time, and I'm going to use some Yahoo data which is readily available to you so you can follow along at home. Prior to the coronavirus, Tyson stock was doing quite well. Obviously, over the past 2.5 months, it's taken quite a dip, and right now, though, it is struggling just below the 50-day moving average. Now, I don't know if it can hold at that level or not, but just a few months ago, the stock was trading at around $93. Currently, it's around $55. So it's off its recent high by more than 40%. And I think this is likely a good entry point, although I do want to mention that it could drop lower. In fact, it could go back and retest those March 18th lows. One thing I do find reassuring is that this week, after they announced earnings, there was what I felt to be really good price action and a lot of volume buying right around that $55 to $56 range. So I'm comfortable with this entry point. And again, using Yahoo data, let me point a few things out. And I do want to say straight up, I know this is static data and this is based on past performance, but I'm okay with that. As I've said many times, COVID-19 is a virus. It's not stage 4 cancer. It has a shelf life expiration date. At some point, it will go away. So assuming that sometime in the future, Tyson can get back to where it was, well then two things are really attractive to me. And that's the forward price per earnings ratio and the PEG, the price per earnings ratio based on a 5-year growth projection. So looking at the forward price per earnings ratio, if Tyson after this crisis can get back to where they were, that gives them a forward price per earnings ratio of well under 10, which I think is extremely attractive, particularly when we're looking at 10-year Treasury interest rates, which are only about 0.6, 0.7%. And then what I find even more compelling is the PEG based on 5-year growth is just slightly above 1. Now, if you remember the old sage advice from Peter Lynch and his metric about trying to buy stocks that had a PEG of 1 or less, then at 1.03, I think Tyson stock could be a good buy based on that alone. Oh, and as a bonus, Tyson is also paying a dividend of about 2.95%. So again, I think this is a good entry point. This company's been around for a long, long time. I think they're going to easily survive the impacts of this virus. And although I realize I'm making my projections based on static data from the past, assuming that at some point in the future, they can get back to their pre-crisis highs, well, hey, I'm a patient man. Even if this takes 3 years to occur, for the stock to get from its levels now of about $55 to $56 back up to $93, that would be an increase of over 66%, which, even if it takes 3 years, that's a rate of return at 22% a year, and plus you collect a dividend while you patiently wait. Well, hey, as always, thanks for watching. Until the next episode, this is John Pugliano wishing you the very best returns.